Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. We have a big episode today. There is a lot to cover. We are certainly living in interesting times. Let's jump in. And we begin in Asia. A sweeping sell-off in semiconductor stocks has rippled through global markets, beginning in New York and moving through Asia in trading today, raising $500 billion in market value and exposing mounting unease over the artificial intelligence (AI) boom's most celebrated winners. South Korea's Kospi index plunged as much as 6.2% on Wednesday today, a huge fall as tech giants Samsung Electronics and SK Hynix dragged the benchmark lower. In Japan, Advantest Corp, a key supplier of chip testing equipment, sank nearly 10%, pulling the Nikkei 225 down more than 4%. Together, the rout has wiped roughly $500 billion from the combined market capitalization of the Philadelphia Semiconductor Index and Bloomberg's Asia Chip Gauge in just 2 days. The sharp pullback underscores how stretched the AI-fueled rally has become after months of record-setting gains. Semiconductor makers have added trillions in value since April as investors bet on unrelenting demand for chips that power machine learning and generative AI systems. Wall Street executives have warned of an overdue correction, while fading hopes for Federal Reserve rate cuts and a prolonged US government shutdown have added to the drag. The sell-off also reveals how dependent Asia's markets have become on a small cluster of AI-linked stocks. If you thought the US market was too overly weighted to technology stocks, wait until you see Asia. 6 companies, including Alibaba, Xiaomi, and Kuaishou, account for half of Hong Kong's Hang Seng Index returns this year, according to Financial Times data published in a report yesterday. In South Korea, Samsung and SK Hynix together generate 40% of that nation's Kospi's gains, while Taiwan Semiconductor Manufacturing Company alone contributes more than half of the TAIEX's year-to-date advance. In these markets, they are incredibly weighted to these massive technology giants. Valuations tell a similar story. Look at China. Shanghai-listed Cambricon Technologies trades at a staggering 506 times earnings, and China's national semiconductor producer, SMIC, at 221 times, compared with Nvidia's 58 and TSMC's 25. Some argue that this is an obvious sign of a massive bubble in China's technology sector, with one calling it a technology bubble on steroids. Quote, if US tech goes down, Asia goes down. Basically, it is a dependency, end quote, said Alicia Garcia Herrero, chief Asia-Pacific economist at Natixis. However, some see a different story emerging. Hao Hong, chief executive officer at Lotus Asset Management, argues that China's new technology champions are growing too fast to be judged by traditional metrics. Quote, if you only look at the valuation to judge those newcomers, it will be very difficult. Its earnings are growing exponentially. End quote. Others believe the rally reflects not speculative excess, but a structural shift in global demand. Quote, we think it's going to be a mega refresh cycle in terms of how data is stored, end quote, said Stephen Yeo of Blue Whale Capital. Still, with US technology giants in the Nasdaq 100 trading at an average price-to-earnings ratio of 35 versus 20 for Hong Kong's Hang Seng Technology Index, Asia's broader technology valuations appear more restrained. Quote, while we're mindful of premium valuations in semiconductors, the broader technology complex trades at reasonable levels, supported by earnings growth and balance sheet strength, end quote, said Charlie Linton of investment firm 91. Even so, the latest rout serves as a warning that the global AI euphoria rests on fragile foundations and that even the most transformative technology trends are not immune to gravity. Next up, we move to North America. Prime Minister Mark Carney's first budget, presented yesterday, Tuesday, marks a sharp pivot and, frankly, a big gamble in Canada's fiscal and strategic direction, blending expansive new spending with a more pragmatic recalibration of climate and defense policy. The $167.3 billion Canadian, $118 billion US dollar in additional deficits over 5 years is the cost of this ambitious plan to rearm, rebuild, and reorient Canada's economy towards resilience and global global competitiveness, even as growth slows to just over 1%. At the heart of the budget is a massive 82 billion Canadian, $58 billion boost for defense, including pay rises, cyber defense upgrades, and rearmament programs designed to support domestic industry. Ottawa aims to meet NATO's 2% of GDP defense target this fiscal year, with 6.6 billion Canadian allocated to a new defense industrial strategy, prioritizing Canadian supply chains. Government-owned Business Development Bank of Canada will inject 1 billion Canadian into loans and venture capital for defense and security firms, while another billion supports dual-use technology commercialization. The finance minister called the plan a, quote, new course for Canada's public finances, end quote, emphasizing that day-to-day spending will be balanced by 2028 through 29, while capital investments fuel long-term growth. Canada's debt-to-GDP ratio will rise modestly from 42.4% to 43.3% by 27 through 28, a relatively healthy level by G7 standards and a departure from Justin Trudeau's declining debt commitment, but still the lowest in the G7. Quote, we must use this fiscal firepower to make generational investments, end quote, the finance minister told Parliament. Still, analysts are divided. The senior director of Canadian economics at financial services company Desjardins Group called the deficits, quote, in line with expectations, end quote, but noted the budget fell short of its promised transformation. A Business Council of Canada executive described it as incremental, though he praised new spending on infrastructure, critical minerals, and streamlined environmental rules. Indeed, the Prime Minister's economic strategy hinges on investment and export expansion. The government aims to crowd in $500 billion Canadian dollars in private investment over 5 years, leveraging public capital to attract global partners and build trade corridors. Yet the timing is fraught. Tariffs from both the United States and China have weakened Canada's export-driven economy, and Washington's recent decision to suspend trade talks has underscored how fragile the relationship remains. On climate policy, Carney's so-called climate competitiveness framework marks a clean break from Trudeau-era regulations. The controversial cap on oil and gas emissions will be scrapped in favor of an expanded industrial carbon pricing system and incentives for carbon capture and clean technology. The government argues this market-based approach will still achieve net zero by 2050. Quote, investment, not prohibitions, end quote, in Carney's words. Alberta, long hostile to federal limits on fossil fuels, welcomed the move, while environmental groups warned of, quote, backsliding, end quote, toward extractive industries. The budget extends generous green investment tax credits and introduces a $2 billion Canadian sovereign fund for critical minerals, while promising tighter rules to prevent corporate so-called greenwashing. Yet its tone is definitely much more pragmatic than the previous, more ideologically tinged Trudeau policy. A bet that growth, defence and industrial strategy, not regulation, will define Canada's path through an era of trade wars, geopolitical realignment and economic headwinds. For Carney, the former central banker turned Prime Minister, this is more than fiscal policy. It's a fiscal gamble on Canada's economic future. The stakes are large, and so, evidently, will be the deficits. Whether this bet pays off, of course, only time will tell. Now, if you want to continue to be on top of the most up-to-date analysis on the biggest developments in the world's most important markets through grounded and sober coverage and a balanced digest, consider subscribing to Market Update at the bell notification icon, and you will be. And if you're getting some value from today's episode, it's a huge help if you can just hit that like button. And finally for today, we move across the Atlantic to an economy that wished it had the fiscal space of the Canadians. UK Chancellor of the Exchequer Rachel Reeves has been warned that Britain must achieve a primary budget surplus for the first time in a quarter of a century to halt its spiralling debt trajectory. The National Institute of Economic and Social Research, which I'll call the National Institute for simplicity here, said on Wednesday today that Reeves needed to find at least an additional £50 billion in her November 26th budget to stabilise public finances and build a buffer against future economic shocks. The last time the UK recorded a primary surplus, when revenues exceed spending excluding debt interest, was in 2001 under Tony Blair's Blair's Labour government, when robust growth kept public debt below 30% of GDP. Today, that figure stands close to 100%, with higher interest rates compounding the strain. According to the National Institute Director, David Eichmann, the, quote, trajectory of UK public debt is becoming unsustainable, end quote, and without decisive action, the burden could soon exceed 100% of GDP. Unlike in the earlier 2000s, when economic growth outpaced borrowing costs, today's fiscal environment is far harsher. The think tank warned that interest rates now exceed growth, meaning Reeves must generate primary surpluses simply to prevent debt from ratcheting higher, a reversal of the conditions that allowed Britain to borrow cheaply for more than a decade after the financial crisis. Reeves, who last year raised taxes by nearly £40 billion in her first budget, now faces a new gap of £20 billion to £30 billion, according to forecasts from the Office of Budgetary Responsibility, OBR. The National Institute, however, argues the shortfall is even greater, and that Reeves should build an additional £30 billion buffer to weather future shocks. Without it, the Institute warns Britain risks losing its ability to respond to crises, invest in long-term growth, and maintain market confidence. The Chancellor has already signalled that tax rises are likely, refusing to repeat Labour's election pledge not to raise income tax, VAT, value-added tax, or national insurance. Her main fiscal rule requires that day-to-day spending be covered by tax receipts by the end of the decade, a target now made tougher by the OBR's downgrade of productivity growth forecasts. The National Institute predicts GDP growth of 1.2% in 2026 and 1.5% after that, though a major fiscal consolidation could dampen those prospects. Inflation is expected to stay above 3% until spring, before easing to the Bank of England's 2% target, with 2 small rate cuts anticipated next year. In a separate report, a coalition of think tanks, including the Adam Smith Institute, Institute for Public Policy Research, and Centre for the Analysis of Taxation, urged Reeves to reform Britain's, quote, outdated and distortionary, end quote, tax system to boost productivity and investment. Their proposals, under the banner Tax Reforms for Growth, outline ways to make the system fairer and more pro-growth, without worsening the deficit, as the Chancellor prepares for what may be one of the toughest budgets in modern British history. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Wednesday, and I hope to see you for the next episode, which will either be tomorrow or more likely on Friday.